What's going on, everyone? I got an awesome video for you guys today. See, I was on a speaker series a couple days ago, and I was asking people, what would you do if you knew a stock was going higher, or if you thought a stock was going higher? And about 75% of the respondents said they would buy a call. Now, when I put them to the test, when I asked them why they would buy a call, and a couple things about calls, very few people actually knew the answers. So, before you get into it, before you go out there and start buying calls and everything, before you get into buying options in general, there are 4 things that you need to know. I'm going to go over those very, very quickly in this video. But again, don't go forward with buying calls before you know these 4 things, or you're going to be buying something you don't know enough about. I'll see you guys inside the computer. Alright, boys and girls, we're back inside the computer and we're talking about what happens when we buy a call. This will be a short one. It will be very instructional, very informative. However, it's very, very important that everyone understands all the fundamentals when it comes to buying options and specifically buying calls before you get into anything. You need to know what you're doing before you get into there. You know, quarterbacks in the NFL, teams in the NFL and any sports, they have a plan. They have an understanding of what goes on before they get into the game. That's what this video is going to serve. That's what the purpose of the video actually is. Before you buy into a call, you need to know what's going on. So let's talk about it. So first of all, what's a call, right? It is a contract to buy an agreed upon amount of shares. So every single call at expiration is worth 100 shares of stock, right? So it's agreed upon amount of shares of a stock at an agreed upon price. Every single option has a strike price, okay? And every single option has a strike price. That's the agreed upon price at a predetermined date, which is the expiration of an option. Now, on top of that, during the length that you hold the call that you've purchased, you are synthetically long the same amount of shares as the delta of the option that you own. Now, there are 4 things here. The agreed upon amount of shares, at the agreed upon price, at a predetermined date, and all the while you are synthetically long X amount of shares. We're going to break down all 4 of those right here, right now. So the first one, an agreed upon amount of shares. So every option of a stock, right, that is not cash settled or is not a futures contract is worth 100 shares of stock at expiration. Okay, we'll get into that a little bit later. So if we buy 5 calls, we agreed to have bought 100 shares of every option we own, or 500 shares of that stock. Now, we're going to get into that in more detail later on. But as of now, every option is worth 100 shares of stock. That's the first part. Now, the second part, at an agreed upon price. So the strike price of an option is our agreed upon price at expiration. So let's go take a look at that. So for example, let's kind of hide this for now. Don't want to jump the gun. If we go ahead and buy this 290 call, for example, okay, again, at expiration, that's going to be worth 100 shares of this stock, which happens to be SPY, right? The agreed upon price is $290 a share at expiration. That is the agreed upon price. Now, for example, again, like we just mentioned, if there's a $100 stock and we were to buy that option, we would be agreeing to buy 100 shares of that stock at $100 a share. That makes sense. So again, at this point, we talked about an agreed on amount of shares, 100 shares per every option, at an agreed upon price, whatever the strike price is of that option. And the next is at an agreed upon date. So the whole business about potentially having to buy 100 shares for every option we own at an expiration price that we own, right? This all goes down when the option expires. So again, remember from the top, we have an agreed upon amount of shares. Every option is worth 100 shares of stock at a predetermined price. Here, if we were to go ahead and buy the $290 call, that would be $290 a share. Okay, so at expiration, or if we're going to do the 285 call, that's going to be $285 per share, and obviously every option is 100 shares at expiration. Now we have this predetermined date where this all goes down. The date where this all goes down is the option's expiration. So in this expiration, July 20, 2018, this expires 43 days from now. And if we look at all the different options chain, every option in these chains expires on those dates, okay? So that's what that part is. Let me just scroll down here really, really quickly. And here wherever we are, great, that's it. Okay, so that's what agreed upon date is. And I told you, throughout the life cycle of that option, so until our option expires or we get rid of it, we are synthetically long shares that are equivalent to the delta of our option. So for example, if we own a 10 delta call, we get the same profit and loss as if we owned 100 shares of stock. So let's actually show you why that's possible and how that actually is. So let's see this. Price slices, great. So again, we have purchased the 290 call expiring 43 days from now. So again, what does that turn out to be? Again, we've agreed, because we've bought an option, for every option, that is equivalent to 100 shares of stock, right, at expiration. And at expiration, that would be $290 a share. That's our strike price. And when is expiration? 43 days from now. But in that time, that option is going to be the same share equivalent synthetically as its delta. So we see right here we have 5 deltas, okay? And we said that's going to be the synthetic share equivalent as owning that many shares of stock. So let's say we own 5 shares of stock, right? 5 deltas. If the price of the stock goes up $1, we make about $5. If the price of the stock goes down $1, we lose about $5. Now, if we were to go ahead and buy that 5 delta call, right, here is what would happen. If the stock went up $1, we'd make about $5. If the stock went down $1, we'd lose about $5. That's that synthetic share thing that we were just talking about. Now, how do we make money by buying calls, right? Well, there's 2 ways we can make money. First, the stock moves in our favor before expiration, and we sell for a winner. That makes sense. The stock goes in our favor. We just saw on that 5 delta call, that if the stock went up $1, we'd make $5. And if we sold that, we would be a winner, right? That's the first way we can make money buying calls. And the second way, the call option expires in the money. In the money. Let's explain that really, really quickly. In the money call is a call where the strike price of the call is below the price of the stock, thus the call is in the money. So for the 290 call right here, the 290 call, for it to be in the money, the price of the stock, SPY, would have to be higher than the strike price at expiration. You see how this comes full circle. So again, in order for the 290 call to be in the money, which is how the option makes money at expiration, we need the stock to be above the strike price at expiration. So we need SPY to be above our strike price, which is 290, 43 days from now. That's the second way that we make money with an option. Now, here's the thing. If we have a stock that's trading at $90 a share, and we've purchased a call option at the $100 strike, the only way the call is worth anything, let alone profitable, is if the stock is over $100 a share at expiration. We call that in the money, as all out of the money options expire worthless. So again, if we go back to this example with SPY, if the stock is not above $290 a share at expiration, or if this option is not in the money at expiration, it is worth absolutely $0. Thus, we don't make any money on that option. Okay, everyone, let's recap what we just talked about. Remember, a call option, right? What it is an option. What is an option? An agreement to buy or sell 100 shares of stock for every option at a predetermined price at a predetermined date. And during the life of that option, right? During the life of that option when you own it, right, you are synthetically long the same amount of shares that are equal to the delta of that option. Now, how do we make money on an option? Well, there's 2 ways we make money on an option. The first is it goes in our direction before it expires, and we sell it for a profit. Okay, that's the first thing. The second thing we could do to make money with an option is it expires in the money at expiration. So if we talk about calls, right? If we buy a call, the only way it has any value at expiration if the price of the stock is above our strike price at expiration. Those are the only two ways you make options. Again, you should know these four things before going ahead and buying options. Otherwise, you'll be buying something you do not know enough about. I'll see you guys on the next video.